Everyone, welcome to the closing bell. It is May 3rd. We had April showers. Hopefully, it brings May flowers. Almost Mother's Day. We got some awesome mothers, so shout out to all the moms out there.
Moms. Yeah. Love the
Mark,
moms.
how
I
you
miss my moms. My mom was amazing. Passed away about 8 years ago now, 92 years old. You knew her, Grandma Boyer. She was amazing. So I miss her, but boy, I sure got a mother-in-law that's still with us, Jan and I. And then I'm always amazed with my wife, Jana. And my girls are all mothers. Yeah. And got a daughter-in-law who's going to be a mother soon, Cassidy. A lot of things going on. So I like the mothers. I celebrate moms.
Absolutely. They are
Yeah.
superheroes in their own right. I couldn't imagine doing what they do, whether it's work and taking care of kids, which is in itself the most important job, right? So it's crazy. Plus dealing with us lugheads.
Yeah, for right. Uh, Childlike husbands, yeah. So anyway, yeah, we're a pain in the rear as well. But yeah, I always, man, when I especially, and because you got your wife's, Melissa's pregnant, and you're just like thinking, man, I'm glad I'm not a girl. I'm not near as tough as they are, and all the stuff they got to do, multitasking, all the things. So we're blessed. We're blessed.
We are. But we got some good stuff. So obviously the saying goes, what? Sell it in May and go
Go
away. So
away. Yeah.
kind of a theme
So,
here.
all right. So explain where that comes from, Jason. Yeah. Tell us why do they say that?
So typically the best months for the market would be November through April, right? And then they say, from May to October are kind of historically the months for bears. Although if you look at the S&P ranging from, the last few decades, it's actually averages about 1.8% up. So
Which
hardly,
isn't bad. I mean,
yeah,
that's pretty good. Almost 2%,
yeah.
so.
Exactly. But historically, that's just the months that kind of bring the most volatility. Could we see more of it because election season? Absolutely. But yeah, hopefully May is a good springboard into some more optimism. I had a great year so far. Just to give a quick recap here, Mark, before we kind of get into the technical talk. Year to date, Nasdaq's up 7.61, S&P up 7.51, Dow up 2.66, small cap is up 0.21%. So all up for the year. April, we were down 4%. So why don't you talk about kind of where we're sitting right now and the trends you're seeing?
Yeah, I mean, so we were talking about in prior months. I mean, markets had a huge move since November. I mean, it's like, and there was a bit of time there where it's like we hadn't even had a 2% pullback. So, it's way overdue. And so, you know, um, investing is an interesting deal. Like you want to see it go up, up, up all the time, because that's a feel good thing. But yet long term, for really long term, capital, for growing your money long term, it's really, you're going to see, especially in the stock market, where it's volatile. I mean, it goes up and down. Sometimes it's pulling back, and we were waiting for that to happen, and it did. And so, actually, that makes it, it's actually really healthy when you get pullbacks where there's profit taking, where there's any kind of bad news, somebody misses an earnings, whatever it might be. In this case, it's always been about inflation not coming down enough, inflation reports that are still high, and higher for longer. Fed's going to keep, all these things that the media jumps on and everything. It becomes, kind of the word for the day at the time. And so, but it allows people to sell for some reason and take profits. And and we've had a big pullback. AI stocks, Nvidia, Supermicro, some of these stocks have really come back down to earth, and then yet showing strength. Actually, again now this week. So yeah, so that pullback, the last this last month or so has been, actually
Much
really healthy. I think for the market, it's actually really healthy. So, and it's interesting where we find ourselves, now. So, but yeah, but that's part of it. So,
good points. And this week, we're like you said, we're up. Up the major indices. Small cap, Nasdaq, Dow Jones up, all up. Excuse me, over 1%, almost 1.5%. S&P is kind of hovering around 0.5% right now. But we've been talking about the tale of two economies, right? I mean, corporate earnings, 80% of the S&P that have reported. We've had about half of the S&P 500 report earnings so far for this most recent quarter, and yeah, 80% are beating estimates, earnings
Yeah.
estimates. So that's a good sign. And then you have big tech. It's kind of like, okay, like now it's time to put your money where your mouth is. Everyone's been AI, this theme. It's the world's changing and evolving and growing, and lots of money's poured into microchips and semiconductors and cloud software services, financial systems. AI's kind of worked into that as well. But then you're seeing these companies now. It's like, okay, well, there's been a lot of money flow into these companies and capex, capital expenditures into these kind of new sectors, AI specifically, in that cloud space of growth. Now, what are we going to do with it? Well, now Google, they spent a ton of money on AI. They're actually paying their first dividend, right? So
Yeah.
now they're going to kind of go into
That's
the boat
huge.
of Apple and Microsoft, these big tech companies that are starting to reward their shareholders for investing and owning their company, and so they can kind of fall in that hopefully dividend growth category like some of these other big tech
Yeah.
firms. So that's always really exciting for me to see as an investor.
Yeah, so I mean, there's a company there that now has profits. They've grown tremendously, and you get to a point where, a lot of times with companies, they're in the growth mode. They're growing, putting money back into their company, blah blah. To increase their size, exposure. All around the world, all the things they're doing. But then they hit a place of maturity where they're not doing that quite. They don't need to do that as much, and so that's when they start paying out these dividends, and that's a huge deal to see that this week. And we love dividends, right? So that's a good thing, and so that's the sign of that company actually getting into a very mature state that will be kind of moves it into really another realm in the markets. Value play. They get when you start paying dividends, they get into different types of money managers out there that are dividend oriented. That if they start increasing their dividends, so that's kind of the maturation of a company from small to through the process to a larger dividend, multinational dividend payer stock. So it's interesting. The AI stock, you're not going to see that with Nvidia right now. And those, they're just growing so quickly, and all that's going back into research and development. They're not going to pay the benefit to the shareholders, and then it's just capital appreciation all the way in the stock price. That's the goal. So,
Cash flow behemoth,
yeah,
absolutely. So it's very interesting. You look at the most recent numbers. Inflation, Fed's preferred gauge is hovering around 3%, give or take, right? Um, I looked up the last 100 years of CPI inflation. We're averaging about 3.1%
yeah,
annualized. So
yeah,
we're
yeah,
kind of right there, and the Fed
yeah.
has this
Interesting. Yeah.
this kind of, they're hell bent on getting us down to 2%. It's like, well, maybe we're just reverting to the norm here of 3%. And I know you've talked a lot about this.
Yeah, we've said it a lot. I mean, yeah, I think that's a great place. I mean, that's a place that you can land long term. It's been 100 years. I mean, really? I mean, that's been our our average rate of inflation over that period of time. Now, there's a lot of differences now in the way they printed money and the debt levels, all those things. But that's really interesting. We've said that really, Jason, last 12 18 months is that, man, was that 2% really, you know why is that, why is that the number that the Fed's shooting for, and it's kind of in their craw to make that happen. But right now, that 3% seems to be kind of where it may land, and it may be hard and sticky to get to 2%, and that's what's going to be interesting. That's why we're in this period right now. It looks like higher for longer. So yeah, and we'll see how that plays out.
It's been very interesting. So the U.S. economy, people don't realize this, the U.S. economy can easily handle 3%. That's a very doable rate. If you look at, so last quarter GDP growth was around 1.8, which was softer than normal, which was part of the reason for the pullback. The economy seemed to have been slowing. But if you kind of dive into that report, consumers are still spending on goods and services, specifically services. That's kind of been the hot sector. We call it funflation, right? People are still spending a lot of money going out, traveling, concerts, games, venues, all that kind of stuff. But actually, if you look at us compared to the rest of the developed world, you look at Europe, you look at Japan, Europe, 0.8%. economic growth over the next year, 0.9% for Japan. Even us, we're looking still, we're kind of that shining city on a hill per se. 2.7% is kind of the newest kind of annualized performance for GDP growth over this next year. So, with that being said, we can handle this. Again, we can get into the nuances, but based off of where we're going with the latest job numbers, it was 170,000 jobs added this week, according to the most recent payroll.
Today, right? Came out today.
They were expecting quite a bit more than that, 240,000. And that was even, we had upwardly revised last month of around 315,000 in March. So 175,000 down from 315,000 from March. So slowing down in a good way. Yes, that's what the Fed wants to see. So are we still expecting 1 to 2 rate cuts, do you think, at the end of the year? Are we lucky if we get that?
I don't really know what, I mean, we will probably be lucky. We think it's going to be, and again, we've been higher for longer for a while. We've been talking about that. The rate cuts are, once at the beginning of the year, it looked like it was going to be a lot of rate cuts. And then now, the way the numbers have come, it's clear it's going to take a longer period of time for that. But what's interesting is that it really doesn't matter, like today. So today, right, we get these job numbers and the markets rallied today. It's big, Nasdaq actually, interesting, is up above its 50-day, back above its 50-day today. Gap there, which is a really good sign off of earnings yesterday. Apple and some other, just gapped up based on these numbers. We're above 16,000 again, and what S&P is, right? The 50-day was at 16,057, and we're 16,151 as of this recording. So if it holds that's going to be very solid. You get back technically above a 50-day. That's a big. It's funny that both the S&P though and the Dow are right at the 50-day, so they got a little bit more work to do to get above it. Yep. And so for those two, we might be at a little resistance and maybe get a little pullback here. Let's see what happens. But all that to say is that interest rates, it really so again, and some people don't realize this, I think, is we wait for the Fed to drop rates, but the reality is that the market itself on a daily basis is adjusting rates. And then today, based on those numbers, we had the 10-year, and we've talked a lot about the 10-year in this on these podcasts. The 10-year is currently right now, as of this, it's at 4.5, and it was just at 4.7, 7.4. Just back on April the 25th, so not very long ago. And now, based on these numbers, the interest rates, 10 years dropped tremendously, which is good for our fixed income, right? So that's all good. So point is that the markets are basically, adjusting to, and showing that, that they're thinking that the interest rates are going to be coming down in there as well. But they'll, in the meantime, those are your adjustable rates and all that. They kind of adjust as they go. It's interesting. So market's doing that on a daily basis, kind of factoring those numbers in too.
Yeah, and somebody brought up a good point to me yesterday. We were talking about bond market and how they're so highly correlated right now, and that's kind of the new era of this, how they've been acting. So today, even stocks are up, bond prices are up. So it's good for bond holders, good for stocks. It's quite interesting though. Is you look at the bond market like you're talking about, it's traded. There's a lot more bond traders out there that are more active these days than in years past. So that's why you're seeing yields drop dramatically. I mean, down even just today, 1.38% for the 10-year, like you were talking about.
Mm-hmm. Yeah.
5 years down even more, 1.68. So again, it's very interesting to watch this. So again, the whole importance of diversification. That's why we've been talking about kind of that alternative sleeve lately is something that, again, can kind of help lower the correlation of a portfolio in times of volatility or uncertainty. But good point. I think that's really key to our listeners and viewers here is bonds are actually moving. We don't need to wait for the Fed to move. The rates are going to move probably before that, as soon as it starts signaling that they could potentially do that.
Yeah. So anyway, it's interesting to see, and we'll watch and see if we can hold these 50 days. That'll be important right now for this next week going forward. So
love it, Mark. Well, we'll let our listeners go for this week. Again, hopefully April showers bring May flowers. We're always optimistic here, but we want to be realistic. It's always great to break things down with you, Mark. And we'll
Likewise.
see you guys next week.
See you, Jason. Bye bye.